It takes us to our talk of the tape. This remarkable run for stocks up 60% since the bull market's start. How much can we count on this rally to continue? We will ask Malcolm Ethridge. He is managing partner with the Capital Area Planning Group, also a CNBC contributor, and is here at Post 9. Welcome to New York. It's good to see you here.
Yeah, always good to see you.
I guess that's a key question, right? We're 2 years in this week. Saturday's going to mark 2 years of this bull market. How long can we count on it lasting?
How much time we got? I think that AI really is proving that it has that kind of staying power. Last year, it was the story was Microsoft. This year, the story has been NVIDIA. What's going to be the stock next year that the AI arms race powers higher and higher? That's the real question we should be asking, not necessarily will it go on.
So I guess implicit in that is your belief. It sounds like that you think mega caps are going to continue to take us to the promised land here.
Well, yes, and I think mega caps will definitely continue to take us to the promised land, not at the pace that they have the last couple of years necessarily, but I think that what we're seeing is the broadening, to use that word that we keep using, is really being impacted by AI once again, right? So you look at things like real estate, you look at things like energy, you look at materials, manufacturing. Those things are all really being powered, again, by our demand on the grid.
Let's talk about this 2-year-old bull market, because it's overcome a lot. Now, there do remain naysayers on what's happening. I don't think as many as existed before, but can you just speak to the resiliency of this market and what continues to guide it today in the face of continued noise here, there, and in parts everywhere?
Yeah, I think you're making a really good point. If you consider that rising rates were supposed to be the thing that really crushed the markets, and in the face of the highest rates we've seen historically in decades, right, the market said, I don't really care. Especially since the companies powering the market's outperformance were ones that didn't really need to borrow to invest in growth anyway, right? If you consider the cash sitting on the balance sheet of a Microsoft or a Google or an Amazon, they weren't really worried about the Fed, so they could go build these LLMs that are powering still the AI revolution that we're talking about. So now we're at a moment where we're in an easing cycle. The Fed is cutting rates, which means that the companies that couldn't necessarily invest in growth to catch up to what's happening with the trend have the capacity now to either issue debt or go borrow to invest in AI, which gives us another second leg of this AI revolution.
Do you feel like we need to reset our expectations at all on where rates are going to go from here, or the pace at which the Fed is going to continue to cut rates? I go to the minutes, which were released an hour ago. Markets pricing in a 20% probability now of no change in November, although obviously the overwhelming number is still favoring 25 basis points. But the pace of what the Fed is going to do feels like it's going to slow.
I think we have to at least brace ourselves for the idea that the Fed could decide to go slower from here, right? To your point, maybe it's still 25 basis points at the next meeting, but then it's 0 for some time, rather than assuming that an easing cycle means it's an elevator down, right? It's been an escalator up. Probably won't be an elevator down.
That's your point of view? Because, look, I remember you were one of the outliers who were saying, look, I know everybody's on the same side of the boat talking about cuts. There is a chance that they actually hike. Not that you think they'll do that now, but you were unafraid to sort of go against the grain on what you thought the Fed was going to do. I wonder if we're getting some confirmation from hearing the minutes and such that we need to really reset our expectations, not only for what they're going to do, but what the action in the bond market is going to be.
Well, I think that we have to throw out the playbook of what has worked in the past that got us here, simply because we can't look at decades of historical data and extrapolate what's going to happen going forward here, because the whole COVID pandemic cycle that we're still dealing with has been such a unique situation, right? So the fact that unemployment has been as low as it has, with interest rates being as high as they have, and that hasn't really had an impact on a bull market the way that it normally would historically. Those are two things that usually compete with each other for who's going to lead the day. I think that we just have to reset our expectations for what that means. But I do take your point on interest rates, and I look at the fact that historically, right, I have to bring this up again, the yield curve uninverting is usually the sign of things to come. And so we should at least consider that maybe the recessionary indicator that it is telling us something, and we need to position ourselves for that as well.
I mean, does it have the ability to make us further question the multiple, the price that we're willing to pay for stocks if rates remain elevated? Earnings have to live up to a pretty good expectation.